Welcome back to the monthly portfolio update. Currently, the stock portfolios sit at a combined value of over 27,000 Australian dollars. That's made up of my $6,400 that's in my Vanguard account and my 13,684 USD that's in my stake portfolio, which works out to be just over 20 grand. Going through today, the main stories we'll be covering is Meta's stock and their recent rise and great earnings, the First Republic takeover from JPMorgan, and the RBA lifting rates in Australia to 3.85%. First of all, I wanted to give a quick portfolio update and go through everything that's been happening in my stake portfolio. As you can see, the stock portfolio is now up over 4.77%, which is around 622 USD dollars. Looking overall through the market, you can see the overall market has now ripped this year and actually traveled up a lot. You see the recent bounce back, especially with stocks that I own in my portfolio, such as Apple, which is up 26% after one point even being down for me. You can see the run up it's had, and that's been massive on my portfolio, with the stock up over 30% this year. Another good performer of mine has been Microsoft, with the stock being up 15%, and even JPMorgan, which is something we'll get into later, is now up as well. Overall, it's been a good start to the year for investors, and especially for myself, investing last year when things were a lot cheaper, and then now kind of reaping the rewards. In regards with transactions, not much has really happened. In terms of money that I own currently, it's just the JPMorgan dividend money that's come in. But yeah, my goal is not to fund this portfolio too much. It's actually to make my Vanguard portfolio hit $10,000 soon. So this is kind of my main priority in saving cash, but my stake portfolio has been doing great in regards with just rebounding after it was so low last year. Going to my Vanguard portfolio, not much has really changed. I have been investing, I think I invested around $1,400 last month into it. So you can see I hold 10 units of VHY, 51 units of VLC, and then 18 units of VGS. I'll go through these ones more, and I have in the past, just kind of what they are, what they break down, why I'm growing this portfolio. The reason I'm growing this one is just to diversify a little bit. Vanguard, everyone trusts Vanguard, great, strong company. And yeah, I'm a big fan of the ETFs. You can see my largest position I actually own is VOO, which is Vanguard's, pretty much tracks the S&P in America. And yeah, that's my biggest position. That's $6,000 USD, so that's over $10,000 pretty much. Or it's getting towards closer to $10,000 Australian dollars. Overall, the goal is to get this to around 20 to 25k. It's already over 20k, so 22 to 25k before the end of the year. The goal of the Vanguard account is to get it to 10,000 whilst I continue to save up cash. Going through the first story of the day is actually going to be Meta. Meta is a stock that I used to own. I did actually sell out of it. Probably a rough time to sell out of it, but I didn't really mind because it's not something I was looking for long term, especially when they were going on about the metaverse. But everyone who did buy in at the lower prices are extremely happy. As you can see, Meta shares popped 14%, reaching 52-week highs on guidance sales increase. Shares of Meta popped 14% when the market opened Thursday after the company reported first quarter numbers that beat analyst expectations on top and bottom lines. The company also guided a second quarter numbers that were above analyst consensus, and Meta shares are up 74% year to date. Yeah, that pretty much sums everything up. Meta shares being up that much just the year. Obviously, they haven't quite caught up to 2021 levels, but kind of going through, you see Meta shares gains more than 14% on Thursday, touching a new 52-week high as analysts and investors digested positive guidance for the upcoming fiscal quarter and an unexpected sales increase for the first quarter of 2023. The company reported strong results Wednesday, posting a beat on top and bottom lines. Meta reported first quarter earnings per share of $2.20, beating the consensus estimate of $2.03, and revenue of $28.65 billion versus the $27.65 billion expected. yeah, they beat on earnings. Everyone loves when their companies they invested in beats on earnings. Even you have a quick look at the stock. I'd have to quickly search that one up here. But yeah, like I said, I used to invest in this company, and it is a bit sad after you sell something seeing it goes up so much, but I'm happy for Meta investors who have probably had a really hard last few years being in the stock, or last year. Yeah, you can see this kind of shape as it's come back down and then it's gone back up. The 3-year picture kind of gives you a bit more of a broad view on it. You see it's still not at those levels, but yeah, if you were buying in, I think $89 a share was the absolute bottom. If you were getting in at 90 or anything like that, you'd be over the moon with how your stock's gone up. Going through again, growth in China's advertising spend helped lift the company's first quarter numbers, with CFO Susan Lee telling analysts the bump was due to part to drop shipping costs and easy COVID lockdowns for those advertisers. Meta's rally was also driven by optimistic guidance for the current quarter. The company expects sound quarter revenue to land between $29.5 billion and $32 billion. As with other large cap tech companies, people are expecting AI would be a positive point for Meta. Meta did go through, they still do it, but it's not as big anymore in regards with their metaverse stuff. That really was not something shareholders enjoyed. It was kind of just burning money. But a big, massive thing is the cost cutting. And I know they mentioned it earlier, but that is kind of where everyone saw the opportunity in Meta. As soon as they started cutting costs, cutting people, which isn't something you always want to see, but it's got a way better response than anything they did regarding speaking about the metaverse. In regards with investors into it, do I still think it's a good time to buy in? Maybe not right now. Still far from its highs in 2021. But yeah, the stock has completely shot up. But if you're long on it and you think Meta's really going to cut back, then yeah, maybe this is a position for yourself. Here we go. This is kind of another point of view of it. That's why I got the 2 different articles. Is Meta shares up 170% in 5 months despite virtually no revenue growth. And that is true, but kind of going through it again, it's all about them cutting down on the costs and what they're telling the shareholders. Meta is no longer the runaway growth story it was in the past, but you wouldn't know that based on the stock in the recent months. And yeah, Facebook parent reported a meager revenue earning growth of 3% from the year earlier, which again, if you're looking for a growth story in terms of numbers, that's not really it, especially when you compare previous years. But in regards of it becoming a mature company, it's massive. It's hard to grow 20% each year and things like that, but you can always cut costs, and that's exactly what they're doing. As Mark Zuckerberg said, this will be the company's year of efficiency. And yeah, you listen to I saw someone do a word counter of his speech and how many times he said efficient and efficiency and things like that compared to previous years, or how many times they said like metaverse and things. And it was interesting to see. And you can see the change in kind of approach. Even now, the company is pushing its TikTok like reels. You do see that as the company tries to adjust to shorter content, different content. Facebook, which was the massive part of it, they also own other massive social media giants like WhatsApp, Instagram. Yeah, they're trying to change it, become a bit more in time with the younger people. And I think they're doing a good job of it, honestly. As someone who has used their products, will continue to use their products. They just have good services, and it's hard to stay away from their ecosystem, whether that is, like you say, WhatsApp messaging family members overseas, or using Instagram for day-to-day activities and kind of posts. People love it. And if you're an investor, that's what you're looking for. You want the company to continue having its hype, having its kind of the energy around it. That's what you want. And yeah, the time I sold out probably wasn't the best time, but I can't complain. I just hope everyone who's in it is enjoying this big run up after the whistleblower saga and all the other things Meta investors have had to go through. The next story I wanted to go through was actually the JPMorgan takeover of First Republic. As you can probably see, I am a JPMorgan investor. I still own stock in the company. sitting at around $1,174 worth. Reasonable sized position, something I've held for a little while. I was probably buying it when it was too high, but I just wanted to diversify and get out of some tech positions I had. But yeah, 3 years, the company did have that really good time like lots of companies did in 2021 before it had that major pullback, and now the stock's kind of settled off a little bit. Kind of to go through the story, I'm sure you've heard already about it. JPMorgan acquired all of First Republic's deposits and substantial majority of their assets. The acquisition came after regulators took possession of First Republic, resulting in the third failure of an American bank since March. First Republic sets a new wave of concern last month with the revelation that it's lost more deposits than expected. Regulators took possession of First Republic on Monday, resulting in the third American bank failure of March, after a last-ditch effort to persuade rival lenders to keep the allying bank afloat failed. JPMorgan, already the largest US bank by several measures, emerged as the winner on the weekend auction for First Republic, and will get all of the bank's deposits and substantial majority of assets. And yeah, the rich just get richer. You can see the seizure of First Republic resulted in the bank's biggest failure since 2008 financial crisis, when the Washington Mutual imploded. Back then it was also JPMorgan that won the failed bank's assets. Yeah, everything around the banking has been a bit crazy since this SVB in March, and it doesn't feel like, I can't believe it was that long ago now, but yeah, it's kind of since then. Shares of First Republic has lost 97% as of Friday close. Kind of going through more for the JPMorgan side. JPMorgan is getting about $92 billion in deposits in the deal, which includes the $30 billion that it and other large banks put into First Republic last month. The bank is taking on $173 billion in loans and $30 billion in securities as well. Jeez. And you think adding stuff to the balance book, that's massive. The Federal Deposit Insurance Corporation agreed to absorb most of the losses on mortgages, commercial loans that JPMorgan is getting, and also provide it with $50 billion credit line. This is massive that the Federal Deposit Insurance Corporation is actually taking away some of the losses that JPMorgan would have to face. So JPMorgan are getting assets, deposits, things like that, and they don't have to bear the full brunt of all the losses. So as an investor, that's exactly what you want to hear. That's good news. But yeah, the bank is booking a one-time gain of about $2.6 billion and expects to spend about $2 billion on integration costs over the next 18 months. Furthermore, the acquisition will add over $500 million to profit annually to JPMorgan, excluding the one-time cost as part of the transaction. JPMorgan said it will make payments of $10.6 billion to the FDIC. The bank said that First Republic branches will operate normally Monday through its plans on retiring the First Republic brand. Shares of JPMorgan rose 3.3%. Here we go, $13 billion hit. With the weekend auction drew bids from JPMorgan Chase and PNC, as well interest from other banks and highly competitive bidding process. Yeah, I'm sure lots of people wanted to kind of you want to buy it while it's low. They say buy the dip, but yeah, you kind of go through which banks would kind of be eligible. It's all the big banks in America, your Wells Fargo's, your JP Morgan's, your Bank of America's, all those typical ones, Goldman Sachs. But yeah, JP Morgan came out on top, and that's one of the reasons that I am invested into JP Morgan. It's reached that point where it's almost too big to fail, you'd say. It's kind of like the safety net. And yeah, if you think of it from an American standpoint, why would you want to invest your money into or have your money in these regional smaller banks when you just don't know if it's going to be there tomorrow? The thing about having your money in like a JP Morgan is its stability side of it. You pay for the peace of mind at the end of the day. You know it's not going anywhere. It's pretty much, people hate the thought of it, but it is pretty much covered by the government. They're not going to let that much money of that many poor, just civilians and just everyday people lose their money. So it's pretty much guaranteed backed. And since the financial crisis, risk in terms of banks has gotten a lot better. You always hear them talking about it. You hope it's gotten better. But yeah, if I was going to invest in a bank, there's a reason why I'm in JP Morgan. Maybe it is a bit expensive, but there's just a level of trust I have in it in terms of being a shareholder. You can see the official press release from JP Morgan, in terms of them going through it. New York, May the 1st, 2023, JPMorgan Chase today announced it will be acquiring a substantial majority of assets and assumed deposits and certain other liabilities from the First Republic Bank. I'm sure this must have been a massive deal to go through with them. Would have been a lot of people working hard and late on this, mergers and acquisitions. Diamond added, the acquisition modestly benefits our company overall. It is to shareholders. Yeah, it just kind of covers a lot of the basic stuff that was already covered in the last post. That just kind of summarized all of this information. But yeah, it'll be interesting to see how it kind of goes down and see in a year's time as you look back on it and you see all the branches and they get rid of the First Republic name and make it all JPMorgan. The last main story I wanted to touch on was to do with the RBA and interest rates in Australia. This was actually just lifted today, the 2nd of May, and they decided to lift the rates up to 3.85, and as it says, a shock decision, but I don't think it shocked as many people after they just paused it. Yeah, it's a bit of a mess what's going on right now. Australia, despite the rising borrowing costs, will be a short one, with the Reserve Bank surprising most economists by lifting its key interest rate again and warning more hikes might be needed. The RBA board raised its cash rate 25 basis points to 3.85 and its monthly meeting on Tuesday, defying investors who had a bet that the central bank would extend its pause for a second month. The dollar soared and shares sank on the surprise. The move comes on top of 10 consecutive rate rises since last May, bringing its cumulative increase to 3.75 percentage points. Inflation in Australia has passed its peak, but at 7% is still too high and it will need some time yet before it's back in its target range, the RBA Governor Philip Lowe said in a statement. Given the importance of returning inflation to target within a reasonable time frame, the board judged that a further increase in interest rates was warranted today. The Treasurer Jim Chalmers said the RBA move was a really difficult decision for a lot of Australians who are already under the pump. This is a reminder that inflation remains the primary challenge in our economy, he said. Adding to upcoming budget would prioritize the responsible cost of living relief that doesn't add to inflation when it is released next Tuesday. I think this is a nice little kind of way of putting it. As someone who does work in the bank, I think you see it firsthand, especially in mortgages. That's where you see it the most. And yeah, as this sort of one they did here. So a loan size of 500,000, a 0.025 hike or a 0.25 hike in May makes you pay an extra $78 a month. 750k loan is 117, a million is 156, and then the total one. So you see 1,058, 1,587, and 2,117. This is massive for the everyday Australian who's probably budgeted. Lots of people, when they took out these loans, was probably looking at around the 1.99 or extremely low rates, especially in recent times. And now to be hit with this, yeah, it's probably going to hit a lot of families on top of what they're already feeling. And yeah, I was speaking to a lender who works at a bank, and he was saying he did a loan for someone and they worked out the max. If it went up this much, like worst case scenario, this is how much you'd have to pay, and that's the top of your budget. It's now actually broken that mark. So the budget limit that they put on when the guy got his loan has now been passed. So it's a scary time for lots of Aussies. It's a scary time for lots of investors, but yeah, it doesn't look like it's going to be stopping anytime soon. The rates decision came despite last week's release of a weaker than expected inflation, which did surprise, like it said, economists and other people who predicted as things slowed down, the rates would hopefully pause, but not the case. Instead, the board weighed on other factors such as jobless rates at nearly half-century lows, the nation's population expected to swell by 700,000 this year and next, and rebound in property prices. The central bank has lately weathered its most intense scrutiny in decades with the release of the RBA review. The report recommended the creation of a more specialized monetary policy board, amongst other change, with Lowe critical of some other findings, including the current board makes key decisions. Here's the cash rate target, again making it a bit more visual for you, kind of how it's gone and how quick they've lifted it. as the indication that the RBA is prepared to hike rates again. Lowe said that some further tightening of the monetary policy may be required to ensure inflation returns to target and reasonable timeframe, but that will depend upon how the economy and inflation evolve. I see it all the time at work, working at a bank, when you see all the older demographic come in and say, oh, but I had it at, my rate was 17%, 18%, something like that. But yeah, obviously things were a lot, in terms of cheaper there. You could put a house deposit down of like $10,000 compared to the $200,000 you're faced to do now, and issues like that. So although you might see these really high inflation numbers previously, it is a big difference. And you see how steep that hike is in terms of rates. That tiny little pause there before it went straight back up. Yeah, it'll be interesting to see what happens, what keeps happening. The board will pay close attention, they say, just kind of waffling on about the same stuff. Investors responded by propelling the Australian dollar about 3/4 of a US cent higher than US 67C. Stock fell about 1.2%. And among the big banks, the CBA correctly called today's interest rate rise. The ANZ had tipped a 1/4 point rise in August, whilst Westpac and NAB both predicted the cash rate had peaked at 3.6%, with the next move to be a cut. The source of inflation is shifting for goods as the pandemic disruption abates the services. Here they go through a bit more. Yeah, just your normal, typical kind of the overall effects that this has on people. Overall, I think, yeah, the Australian everyday Aussie is going to suffer. And yeah, they kind of want to get it down. You know, they lift inflation to stop people spending. They want to increase unemployment. Just the typical ways that you'd say economists try to calm down inflation. Do I think it was a good decision? I don't know. Again, that's a tough decision that other people have to make. I'm pretty lucky that I'm not in the room that has to make those decisions, because it is easy to just critique what they're doing as someone who's not in their shoes or has to go through any of the scrutiny they have to go through. But I hope everyone does get through it fine. And yeah, I think we'll see exactly what's happening working at one of the banks and seeing people come in and just seeing the first-hand example of what's going on. The next thing I kind of wanted to touch on was kind of around my personal side of it with my investments and myself tracking it. Portfolio stuff I have made. I haven't cleaned it up yet, but I wanted to show a little bit of a tracking. This is just a quick one. I have more kind of like my net worth stuff of it that I might show in the future, but I wanted to do a bit more of a budget breakdown. This is what this spreadsheet's called. This is just a little quick one I put together for the video. I've started to track my dividends. This is just from my stake account. It's not from my Vanguard account. If I am to add that, it will be a bit bigger, future reference, because obviously I've had my stake account a lot longer than I had my Vanguard account. But yeah, it is nice to see the growth. I mean, you look at it, you see the ups and downs of dividend investing. Obviously there's months where you don't get investments, but you see it starts off 0.89, slowly creep up like faster than average, to the point where I even got basically $30 one month, $30 again. And yeah, this is big, $190 total, but I see it this is USD by the way. It's going to keep rising, obviously, the longer I'm invested. The more money I put in, the more my Vanguard account grows, and the more I keep track of that. You can see the progression that it's had since the start of the year on my Vanguard account. The stake progression has been a lot more linear, like a lot more predictable. It's kind of a straight line almost, where my Vanguard account, you can see I'm kind of, when I deposit larger sums of money, it kind of shoots up. But yeah, I'm keen to continue growing that, get it to 10K like I said. But yeah, I plan to showcase a bit more of kind of like my personal finance side of things. I think it's interesting to see. I like seeing videos of people break down. This was just a video kind of summing it all up. I wanted to go through, like I said, tech, kind of what's happening in tech, my thoughts on it as someone who is pretty heavily invested into tech, and what I plan to do in this upcoming month in regards to my Vanguard account. If I am going to invest any money, it will just be straight into VOO. That's kind of like my goal until this gets positive. Just continue investing in it till I get pretty much break even, because it's still under the $400 mark. You look at the last, yeah, here it was when it was in the 430s, I remember. Yeah, it'd be nice. I was investing when it was a bit cheaper as well, but again, I'm trying to take a long-term approach to things and kind of have a longer outlook, where 3 years isn't my outlook. It's more 5, 10, 15. The only time I'll be selling these from my thoughts is if I'm going to go for property soon, or probably not soon, but in the next 2 years. That's when I'd probably sell some of in terms of my stocks. But the more I grow them, the more dividends I get, the more compound interest there is, longer it's there. So the more I grow it, I'll continue to post and upload my journey of my investments. But this is just the update for April going into May. And that's all. Cheers.